Welcome to Trade School for today. Today is what is today? The 18th of January. Okay, good. Thanks, Tag. It's alive. It's alive. Today's the 18th of January, 2019, and today's Trade School is going to be a literal cornucopia of topics. And as I don't really have anything prepared for this. I have a bunch of questions prepared, but I don't have any prepared responses. So you're going to see me kind of tap dance through this. So what I'll do here is I will go with big slides, little doc, and go with that. Okay. So risk disclosure, don't do anything silly, please. So today's topic is questions from the Discord. We had a little Discord out there. Okay, so first of all is Rajith, questions from the Introduction to TA class. Now, I wrote him a response, but the response seemed to be, how should I put it, insignificant. Because I was sitting there as I was typing it out, like trying to explain things in technical analysis through words just seemed to be insufficient. So I offered to him, and like, hey, you know what? Let's do this through a trade school. Okay, so first one came from, again, this is from the Introduction to Technical Analysis class, Module 2, Price and Volume. So what he's saying is that, and let me do this. I'm going to fire up my magic pen here and make sure that everything is good. So you'll see a countdown set up, and now we have the magic pen. Okay, so declining volume on rallies can be suspect. In fact, what I would say is almost every rally that I see has got declining volume in it. Every rally has got declining volume. So typically from something where we have some type of consolidation, we typically will see some type of volume spike that comes into here. I mean, after all, what you've got to get, remember, a volume spike is disagreement. Volume means there's disagreement. If everybody agreed on, oh, yep, go ahead, just go right through here, then there'd be no volume as the price rallied. And to some degree, that's what happens because, again, here's the volume. If we put volume down here, volume there's got to be a huge amount of disagreement because the bears are up here saying, oh, no, you don't. No, you don't. You're not going to get through here. And all of a sudden the price starts to get through there. And then, the bears have got to turn around and cover their positions. So that adds more volume to what's going on. So there's disagreement to that. So there will be a spike that occurs on any kind of a breakout. Now, as the price goes into the next phase, which is sort of acceptance, remember that from the 4 phases of a market rally, as you get into acceptance, then there's less disagreement about the price. There's less disagreement about the price. So it's, after a while, it's like, yep, price is going higher. And so what you'll see is that as the price goes higher, a lot of times you'll see, well, the volume normally is a straight vertical line, but normally you'll see the volume kind of tail down on that. So keep in mind that this is very common to see tailing down volume or declining volume in a rally. Now, typically what you'll see is the price will find like an equilibrium point, and then we'll see what I like to call a parabolic tail. And a lot of times the parabolic tail can have a little bit more volume up here because typically this is where the bears are loading up, or those with short positions are loading up at this point. And again, you get this final disagreement point. And then that's where usually things will start to come down for there. So I don't really look at volume as a leading indicator anymore in terms of a rally. I pay a lot more attention to volume as the price comes down and capitulates. That's where we see generally huge volume on something like that, right? We haven't really seen that yet in crypto. Haven't really seen that in crypto. So this is what I'm kind of looking for. Again, huge volume means big disagreement. Okay, so that's module 2, price and volume. Hopefully that makes sense to everyone out there. Okay, module 3, we had a question about support and resistance. All right, welcome aboard, everybody. If you're just getting on board here with Trade School, or if you're watching this through an archive, sorry about the silly little. We had some tech issues here. It's been one of those weeks. So, module 3, support and resistance. Trend lines are drawn connecting lows in an uptrend and connecting highs in a downtrend. So let's give a visual anchor here to something like that. Let's draw an uptrend, which is higher highs and higher lows. And typically, and I'm free-forming this, I don't have a ruler, so if anybody's going to bust me for not connecting the lows, thou art get a life, right? So that's an uptrend. We have basically this trend line, which is connecting the lows. And let's draw the same thing, downtrend. You guys notice that? Social media is making everybody just so rude. You can't disagree anymore with people. It's like keyboard commandos. So what we have is, in a downtrend, we have an upper trend line, which is generally keeping the price in. So remember, rule number 3 of what we talk about is that ascending patterns will eventually break to the downside, just like descending patterns will eventually break to the upside. It has to happen unless it's going to go to 0 or infinity. So in an uptrend, will the support be found, and in a downtrend, the resistance line that we find? Can you please confirm? Yeah. So generally what you're going to find is, and like Alex is in here, Alex will attest to this, is that we do this all the time. We will see price coming down to a trend line, to a trend line, to a trend line, and that can become an entry, or it can help bolster an entry if it aligns itself with another signal. This is what we call confluence, confluence, right? Okay, so confluence is where you start to stack different indicators together to improve your probability of taking a position. You never know what the future is going to be, so what you try to do is stack the probabilities in your favor. Okay, so that is module 3, support and resistance. We do find support in a lower trend line in an uptrend, and we do find resistance in a descending trend line in a downtrend. Okay? Capiche? Moving averages. You said that with a 200-day moving average, the price action are above the line, it indicates an uptrend. So this is something that I use all the time, and this is, I got this from a gentleman by the name of Larry Connors. Larry Connors has written a whole pantload of books out there, and he does, he's more of a stock trader, right? So he's an equities trader, and he builds systems, and he builds some very simple systems. And one of his filters that I believe you can find out more about Larry Connors at tradingmarkets.com, if I'm not mistaken. So let's call this guy the 200-day moving average. So it's generally a very slow, so you'll see the price doing all kinds of things like this, right? But if the price is above the 200-day moving average, this is the 200, and it's generally a simple moving average, right? It can be an exponential if you want to, but if it's a filter, generally I'll just use simple moving averages. So this is a general implication. Now, somebody will say, hey, the price is below the 200-day moving average. That means it's got to be a downtrend. Well, okay. It's going to poke itself down there occasionally and get hauled back in. But generally what we're saying is, just as a general rule, if the price is above the 200, that implies an uptrend. Now, the question here from Ajith is this rule still apply for any given time period, like weekly, daily, and hourly charts? Yes. Yes, the answer is yes, because the fractal nature of markets, where who says that the daily chart is the only chart that you can look at? Nobody's out there saying, wait a minute, Marcus of Queensberry Rule says the daily chart is the only one that you can use with this. No, a lot of systems are built around the daily chart, or the death cross, right? The death cross of the 50 and the 200 day So if you go around saying, hey, there's a death cross on the 1 hour chart, you're going to have people say, well, so what? It doesn't really matter. So that death cross of the 50 crossing under the 200 is really only meant for the daily chart. But on a fractal notion here, this can apply towards anything. You could set up an intraday day trading scalping system where you want to take longs above the 200 or shorts below the 200, those kind of things. So that's the fractal nature of markets. It really, a lot of the rules that we come up with work at every time frame. Now, what you'll find is that the more you crank down the time frame, the more noise that you'll have. The more, just crazy price action that you'll have based on some news or some data point, which tends to get filtered out on larger time frames. Okay, so that is Module 4 moving averages. Cruising right through these. Hopefully this is helpful for you guys. Some of you, I'm sure, know all about this stuff. Others, maybe not so. Module 6, momentum studies. In the Fisher transform, you're recommended to tune depending on what you trade. Do we also have to tune? It depends on the time frame you trade or looking at. Yes. So here's kind of a more, I don't want to say it's a more advanced topic, but with any oscillator, what you generally want to do, if you're using an oscillator as a signal, so in other words, if you see a hook up or you see some kind of hook down as a short, those kind of things, if you're using an oscillator as a signal, oh, here's a stochastic crossover. What you want to do is you want to experiment with different time frames for that or different time samples for that. So in other words, if you're on a daily chart, maybe you'll start with a period of 14, which seems to be the default period for a lot of studies, and maybe bring it down to 10 or 9 or something like that. See if it lines up better with the signals that you have, or maybe expand it out a little bit. If there's a lot of noise at 14, maybe go out a couple. And so this is something that I don't think a lot of people think about, but if you get into some really deep trading books that are out there, one of the first things that they'll tell you is, look, you just can't take an oscillator off the shelf, plug it in, and have it work, right? So to some degree, so some people are going to say, but you're curve fitting. Well, that's kind of what we do, is we're trying to get in line with what's happening right now. You're always trying to identify the character of the current market that you're trading and trying to get in line with it. It's almost like a marching band, right? Or, a parade or something like that. You don't want to be out of step. You want to be stepping at the same time everybody else is stepping left, right, left, right. You want to be in sync with the market that you're in. And so anything that is an analog oscillator like this, you may have to tune it a little bit. So you might get lucky. You might look at this and say, man, these period 14 oscillator crossovers are just perfect for this market. Awesome. Stick with it. Don't worry about it. But what you find is that it may depend on the asset that you're trading. So you may find Bitcoin is going to be different from a Zilliqa or a Chainlink or something like that. They may all be different. And so I'm not really into this whole sense of, that's the problem that you run into with bot trading is one size fits all. And you're jamming all these square pegs into a round hole in your hope that something comes out on the other side. Okay. So do you have to tune it? Depends on the time frame you trade. Yep. Take a look with it. Experiment. This is how you create a system that's yours. Right? If you just take a system off the shelf, if you go down to Walmart or Tesco and say, all right, where's the trading aisle? And you walk down the trading aisle and there's a bunch of systems that are for sale for you. And please, nobody go look for that tonight. It doesn't exist, right? If you just take a system off the shelf, it's unlikely that you're going to be profitable with it right off the bat. It's the process of going through it and understanding it and learning it and adapting it to you that makes all the difference in this business. There's nothing like it, right? The biggest thing that you'll find from that is that you'll begin to trust the system or the trade setup. If you don't trust the trade setup, you're going to yank it off on the first negative tick every time. You know, you're going to be trading not to lose instead of trading to win. So tuning a system is something that you can do to help that. Module 7, volatility studies. So you said to look for Bollinger Bands, trade inside of the Keltner channels. And I'm going to freehand this so I don't have to. So we have the price here. The price is moving around. And what you'll find is that you'll have a period of time when markets get really flat. So if they get really flat, if they're trending like this and they get really flat, what happens is you'll see, and I'm not going to draw these to scale or how they should be, but what you'll see is that, you know, the Keltner channels will kind of come along like this, the same thing, right? Because they're ATR based. So the ATR drops, average true range drops. And so all of a sudden the bands get closer together. And then what you have is you have the Bollinger Bands, which are based on standard deviation from a center line there, moving average, standard deviation. So what happens is, you know, and maybe these are like this, and then they get inside of here. And this is what's called a squeeze. So this got popular maybe 10 years ago, called the squeeze. Now there's a lot of squeezes that are out there. You can see just a Bollinger squeeze. So if we have the red Bollinger Bands, the price just squeezing down into, so the bands are very, very tight like that, generally implies you're going to see a pretty big move. Now the question is, this can be to the downside or to the upside. Yeah. Yes. So generally what's going to happen is, generally, if you're in a trending environment like this, if you're trending like this, and you have the price, you know, rocketing upwards and then moving into a squeeze, generally the probabilities do favor it going along with a trend, the major trend. Generally it will break out to that if it has all the energies available to it at that level. Now, what we may find is that we move up to this level and we start to squeeze, and then all of a sudden it drops out of this. I mean, I've seen this happen so many times in the past where everybody is leaning in this direction. Everybody's looking for it to go. And all of a sudden it actually drops out of the bottom, and then it moves. Dastardly move like this happens all the time. How do you identify something like that? Well, what you can do, guys, is you can just use your alerts, like box in. This is what I say, box in the price action. So set up those alerts above and below, and just simply look for the market to trade above or below from there. Now, again, the probabilities do favor typically going along with a trend. But this is where guys get into trouble, is where we think we know what's going to happen next in the market. And a lot of times you'll see a wicked counter move happen. And this is because everybody's loaded up in the wrong direction. And they panic and sell out, and it begins this sort of tumble down the hill. Okay, so that's volatility study. So that's with any volatility study, right? So it's not just the Keltner channels inside of, or the Bollingers inside of the Keltners. I mean, we can also look at the fractal energies, do essentially the same thing. We have a very high fractal level. This is where we typically just box in the price, right? We'll even set up something like this. We'll actually come along on the chart and we'll box it in and say, don't know which way it's going to go. If it breaks to the upside, hallelujah, alert us. And if it breaks to the downside, awesome, alert us, please. And again, that's the best way that I found is to start to attack the market. Is newer traders will typically attack the market from an analysis perspective of trying to predict the future. Oh, I need to know technical analysis so I can predict the future. No, that's not the way it works. And you have to unlearn that aspect. You have to unlearn that sort of, I don't know what you'd call that, but it's not true, because guess what? Nobody knows what's going to happen in the future. However, I think the bigger question here, and the more important one, is technical analysis is a tool to be used to tell you what to do when a signal shows up. So in other words, do you know what you're going to do if the price goes higher or lower? Or are you going to be a deer in the headlights and get run over because you didn't anticipate a certain direction? That's what I want you to avoid. Okay, so volatility studies. So that's a great question, because I see that one all the time. Now in trend studies, this is kind of the same thing. In the CHOP index, you said it's not going to tell you which way it's going to break. Do we have to use different tools to that? What kind of tools do you mean by that? I really don't think you need another tool for this. So in other words, if you see something, let's kind of come along here. So we have price going like this and then consolidating in a small little range like this. So what is the CHOP index going to do? It's going to dive down. It's going to say, there's no gas in the tank, Captain. We got nothing left. And then it's going to start to work its way higher. And it's going to be a very high level by the time it reaches this, right? So the CHOP index shows the linearity. Like, how linear is this? This is extremely linear. And this is unsustainable, but this is extremely non-linear, and this is where it's showing potential energy. So we'll just say PE there, potential energy, and it's going to get turned into kinetic energy pretty soon. You guys remember that from freshman physics. Freshman in high school physics. Okay, so do we need more tools in this? No, we can simply do the same thing as before. We can set up price alerts along here and say, and I think the most important thing is just allowing the freedom to say, look, it could go either way from here. Don't know. However, I know what I will do if I see it breaking out. I know what I will do if I see it breaking down from that range, right? So a lot of this, so when you see it breaking down from the range, this is typically when you have a larger time frame. So maybe this is a daily chart, but you might have a weekly chart going like, oh, I'm totally exhausted. And this is where you might see it actually break to the downside because it needs a break, right? It can't sustain any more forward price movement on there. Okay, so that's trend study. So price is the best thing that you can possibly use. It's not going to be a trailing or, delayed study. A lagging study, that's the word I'm looking for. General question. You said that you have to work out on your own decision-making framework based on the studies you teach and based on what we like the most. Out of all the modules and studies that you teach in the class, can we use any of those studies to enter and exit in a trade, including the momentum studies? Or are there certain studies you can't use for this purpose? Okay, so some of the studies, and I do believe, it's been a while since I've looked at the class, but I do believe that I showed each sort of category of studies, like trend studies, like moving averages, right? I'm not a big believer in using moving averages to set up a trade entry. So now you can take this to the nth degree and create a ribbon study, and actually TradingView has a really nice, pretty ribbon study that's on there, and you can use that, right? But what you find is that moving average crossover studies, they're great as long as the price is trending, and they're absolutely horrible when the price is consolidating. And so as long as you can understand the context of what you're dealing with, is it trending or is it consolidating, what time frame, right? Because what's going to happen with something like this is, you're going to see a moving average supporting this, and you're going to say, man, this is so awesome. Every time the price comes down and bounces off that moving average, I'm right there and I can't lose. And then all of a sudden what happens is, whoa, you get you get run through because all of a sudden, and this is typically when you like double down or like you go all in, you back up the truck. I'm going to trade my whole account on this one trade setup. And this is where you get run over, right? And they're done that. So moving average studies like this is where they'll kind of like, they'll get lost. They'll just wander around. They're like, they're like a drunk just sort of wandering around, has no idea because they're just getting whipsawed back and forth. So moving average crossover studies are just, using moving averages in general for a trade entry, I think is a really poor idea, but it can be part of if you are having difficulty finding trend or understanding momentum, you can use something like that. So typically I'll use oscillators for like actual signals for like go, green light, go kind of thing. I'll use momentum studies for understanding, is there perhaps any divergence setting up? Is there a leading signal that's letting me know that maybe the momentum to the downside is starting to fade? And we had one of those trades, oh gosh, what was it, last summer, where we saw some great bullish divergence setting up on Bitcoin, and it gave us a really nice little early warning for a long setting up, a long swing trade that we took. Okay, haven't seen any yet. Let's see, other studies that we use for context are like, again, you'll see me use the CHOP index all the time for understanding what's the context. Is it in range contraction, range expansion? What's likely to come next? Again, it's just based on probabilities. It's not predicting the future. Just saying, look, this thing's exhausted. It's highly unlikely to keep going in that direction, right? It's just giving you the context for what's going on. Like context is important everywhere in life. Like if you walk outside and go, hey, it's a great day, it's sunny outside. Okay, that's true, but it's January. It's cold. You might want to wear something more than a t-shirt, right? Context is important no matter what we do in life. And this is why we use the different tools. So again, what I typically find is, and actually I've got a whole, I've got a fun little presentation on this that I've given over the years based on something that Bo Yoder has done called the trader progression. And it kind of shows how people start out trading, not really knowing what they're doing. And then they find out about technical analysis and they go, oh my God, this is the greatest thing in the world. And so next thing you know, all their charts look like, a modern art masterpiece of like, 15 different studies that are on there. And eventually what you find is that the longer that you do this, you start taking them away. Because you can read the context with very little. And maybe there's only one study that you're actually using for actual trade entry. Could you elaborate on what a divergence is and what it tells us? Okay. Okay, so like we have in this case, let's kind of redo this one. Good question, Ann. So we have, let's draw ourselves an uptrend here that has higher highs and higher lows, right? So nobody would dispute that we have an uptrend with higher highs and higher lows. So we have what's called a MACD, and I love using the histogram for this. So histogram might be, we have something like this. Here's the 0 line. And so we see like this will be, big momentum, and then we'll see it kind of slowing down and maybe even going negative. And then we'll see it big momentum like this, big momentum, and then we'll see it slowing down a little bit and even going negative, right? And then we'll see it sort of crossing up again. Now, what's important here is watch what happens to this. Is like a lot of times you'll see this happen like that. And then we're going like this, and then here's some positive momentum, and then it's starting to slow down again. Probably not really obvious from the first look on this thing, but what we have is Class A divergence right there. So we have of these highs, we have higher highs in price, but we have lower highs on the momentum indicator. So I typically do like using, I find that oscillators, you can do this with oscillators, but I just don't find the signals to be quite as dramatic. The very best one, and this goes back to something I learned from Alexander Elder. I've got a whole pile of books over there on the bookshelf, and trading for a living was Alexander Elder's tome, and it probably came out in the mid-90s sometime. And this was one of his favorite signals. And I'm like, okay, you convinced me, but I learned how to look at divergences. Now, is that something that you can trade off of? No, it's not. It's not where you're like, hey, I got a bearish divergence here, I'm going to go short. No, that's not what you do. So like something like this, what you might want to be doing is, like Alex talked about before, is setting up a trend line. And we know that ascending trend lines will eventually break to the downside. So what we can do is we can go on full alert here. We can say, hey, we got a bearish divergence setting up. And after we break the trend line and maybe pop in a lower high, and once that lower high prints, we might be entering right at this point, and that could be a nice short trade for us. So again, it's stacking up the evidence with each other, right? So you would never use a divergence to actually enter a position. And you can flip this around and you could see a positive divergence on something like this, which ultimately might break to the upside. So Rajit, that is negative divergence. That is correct. This is bearish divergence. Okay, let's see. Do you also use RSI divergence? Cryptomaniac. I personally find it easier to see. Aha. See, this is where I love this. It's actually a great comment because I don't use RSI divergence. I rarely use RSI except for extremes. Like I'll look for absolute and total extremes. If we're using the RSI 14, I will use the RSI 2 for actual like super quick, sell signal, kind of long in the midst of an uptrend kind of thing. But I'm not an RSI guy because I find it to be fairly unresponsive. But if you can see divergence on the RSI, do it, right? I'm more of a MACD guy if I'm looking for divergence. So this is where I think everybody needs to kind of build their own thing. Let's see. It almost looks like a sort of consolidation. Well, yeah. So it's not the easiest thing to learn and is, understand it because it's going in opposite directions. And that's what divergence means. It's like this one's going in this direction and you're seeing the momentum, the lower highs heading down. And just like if you were looking for positive divergence, you would be looking for higher lows down here on this side, right? So that's what a divergence is. And so we can see lots of things that are diverging. We can see volume and like some instruments that we trade and not necessarily crypto, we'll see what are called internals. So like for the S&P 500, we know for a given number of stocks that are out there, we know which ones are ticking higher and ticking lower. And you can see markets that are just heading up. It's a little engine that could. You could see actually what's called tick divergence going down. So you're seeing the strength inside of the market actually dropping well before it drops down. So again, probably something that we can't use in crypto for this right now until the tools grow up. All right, let's keep moving along here. I still got a bunch of stuff to do here. So this is one of Tyke's. Can you explain Heiken Ashi candles? Now, first of all, I don't want to get into hot water here because I'm not going to be able to explain exactly the algorithm behind Heiken Ashi candles. So obviously, if you can't figure this out, this is a derivative of a Japanese candlestick, and this is a Japanese derivative of a Japanese candlestick, right? So let me go over, I'm going to back out of here and let's go over to Let's just go to a single price chart. Let's see if I can. There we go. Now what we have here, this is good old BTC. And these are standard candlesticks here. Standard candlesticks. What other oscillator would help confirm this or help get the correct message? See, that's the problem, right? Everybody thinks that there's one more study that they need to layer on here. And I'm telling you, divergence, the only thing you want divergence or a MACD on there is to give you kind of an early warning in terms of momentum, right? Or some people do actually use it as part of, you got to have everything lined up, right? So yeah, the classic 3-indicator study is, having a moving average, having a MACD, and then having some type of oscillator, whether it's stochastics or something else on there. But again, the less you use, the better. So we just have standard candlesticks on this dude right now. Standard candlesticks. Red means the price is going lower. Well, then this time these are daily candles. Now, what we can do is we can actually go over here. If you see the little candle thingy here, up in the upper left-hand corner, we can change this to Heiken Ashi. And please don't ask me to put Renko candles on here or Kagi or anything like that, because quite honestly, I've never traded them before. It's not saying that they're bad. I've just never, there's only a certain amount of time that you got to play with this stuff. So, but I do use Heiken Ashi, and I like Heiken Ashi. Now, the thing that you'll notice about Heiken Ashi is generally what it does for you is if you have trouble figuring out what direction the price is moving in, put Heiken Ashi candles on your chart, especially an anchor chart. If you don't know what an anchor chart is, go to the Fractal Energy program, go into anchor charts all the time. So something that's a 5x or 25x chart will show you what's going on with this. But I love to put Heiken Ashis on my anchor chart, right? Because as long as it's, like in this case, as long as those Heiken Ashis are throwing off red candles, stay short. Keep looking for short entries. Or as long as the Heiken Ashis are green. And so within there, if we take off, so let's go with the standard candles. Let's go with standard candles, and we're just going to look at this period in here. Right? So this period in here has got a bunch of red and green candles, and this is where everybody gets confused, because it's like, oh my God, there's a red candle on the daily chart. I must be going short. And this is where Heiken Ashis will help you a lot, because a Heiken Ashi candle, in this case, if we go out to a Heiken Ashi, it will say, hello, stay long. As long as the Heiken Ashis are green, stay long or look for long opportunities at your signal chart, okay? A Cryptomaniac, do you use any other volume indicator, on balance volume, CMF? No, I'm not. I'm a troglodyte when it comes to TA. I use as little as I possibly can. I make the basis of my trade entry and analysis around the price. So the longer that I've done this, the more I've sort of shunned away all these other fancy stuff. And not saying it's not useful, not saying it's not a valuable tool. Some people create a whole system around on-balance volume. Some people create an entire system of trading around the CCI. Like if you guys have ever heard of Woody CCI has got a whole system around one study. And I could probably do the same thing around the CHOP index. Okay, so those are what Heiken Ashi candles are. And so what it does is it tends to smooth out the trend. Now what you'll notice here, if we zoom in on this, let's zoom in here. Notice that every new candle starts at the halfway point of the previous candle. And so you'll have to get used to that. It's a different look, right? So sometimes it's a little bit more difficult to figure out within that candle what the actual highs and lows are. because it may not necessarily be that. And if I go to a regular candle, you'll see that the regular candle shows the exact open, high, low, close on there. Whereas Heikin Ashi starts the candle begins halfway through the previous candle. So it's very important that you understand that, right? So this candle begins right there at the midpoint of the previous candle. This candle begins at the midpoint of the previous candle, right? Same thing is happening here. This candle begins at the midpoint of the open and the close, right? It doesn't care about the wicks. So this is how it's done. So again, for those of you that must absolutely know what the algorithm is of this, I encourage you to use Google. It will be your friend and it will tell you exactly how the candle is built. But what I'm here to tell you is Heikin Ashi is great, great, great. It's a very, very nice tool for staying with the trend. That's what it's really for. Okay, so let's go over to, should this be used on longer time frames? I would say, well, yeah, look, the thing here is that I think Heikin Ashi is really good for an anchor chart. An anchor chart, remember, what is my saying when it comes to anchor charts? It's almost like a song, right? Trade in the direction of the anchor chart swing. Trade in the direction of the anchor chart swing. You should have that like up on your wall somewhere. Trade in the direction of the anchor chart swing. That's what we all should be doing. Trade in the direction of the anchor chart swing. So the anchor chart, if you trade in the direction of the anchor chart Heikin Ashis, and don't try to take it too far, right? Don't go too far. Don't get too greedy. You know, like if it shows exhaustion to the upside, maybe you might want to take profits on that long, right? Same thing here to the downside. Maybe as you show exhaustion on this, maybe you'd want to, let's actually go chopping Bollinger's on here. As you get into exhaustion figures, maybe it's time to take profits on these, right? So use them in context with other tools, but I love using Heikin Ashi on the anchor charts because it keeps you going in the direction of the anchor chart swing. All right, let's go to the second half of Tig's question. And that's not it. How to detect when the market has changed from sideways to trending. Tig, this is kind of the same thing that I was talking about before. Is first of all, if you use, let's see if I get the right ones here. So first of all, if you're using, and we don't need to use the Heikin Ashis anymore here. Like, this is a great example where we were sitting there just going nowhere, nowhere, nowhere into early November, just sideways, sideways, sideways. And simply what you can do is you can, what I call boxing in the price action. This is, to me, the best way to do that. It's not a study. It's more of saying, look, price could go anywhere from here. It could go up, it could go down. All I want to know is whether or not it's heading higher or heading lower. Box in the price action, right? And the best way that I know of in TradingView is simply to right click, add the alerts. Add your alerts in there to let you know if it's going higher or lower from a consolidation zone. And so you'll be given a fair warning on this because you'll see chop index typically above 55. Typically above 55 is when it's got enough gas in the tank to make a major move. All right. Hopefully that makes sense. If it doesn't, let me know. And then we had here from, I believe this is Checkmate. I would be keen. I love that. I'd be keen to see how you could use fractal energy on intraday timeframes, say on BTC and ETF, in this extreme chop. Okay, so here's what I do with the FE intraday. The FE intraday is to determine your context on what's going on. So let's see if I can, I kind of messed this up earlier. Okay, so if let's build, shall we build a little intraday chart? right? So we could do something here, like let's start off with maybe 5 hour or something like that. We've got a 5 hour chart and we're going to go too wide. So we have a 5 hour chart and we're going to go with let's go with like a 12-minute. So I'm going to click on this one and I'm going to move down to a 12-minute chart over here. So here's where we can have a little bit of fun, can't we? So we have an anchor chart over here. So here we go. Let's see. This is our anchor chart. This is our signal chart. And I think I got to get the old HP out there. Yeah, that's 300 minutes. So this is a 1:25 ratio. So we're using a 25x anchor chart and we're using a 1x 12-minute chart here. This is the 12-minute chart. Okay, now, so that's our anchor. We want to trade in the direction of the anchor chart swing, and we're going to use the signal chart here to figure out which way or how to time that entry. And this is, I'm going way beyond what Checkmate was asking here, but this is where we might want to go to a Heikin-Ashi over here. So we can do Heikin-Ashi, and boy, is this, I mean, this is about as choppy as we're going to get, right? You can see we're just kind of getting into, we're in a triangle inside of a larger time frame bear flag. I mean, it's just, it's ugly, right? So there's just no direction in here, but we are swinging slightly to the downside right now. We are swinging slightly to the downside. So within the context of this, we would look for some type of signal to give us a short entry within that anchor chart swing to the downside. So the context I'm looking for here is that something like this. Okay, so we're going to add that. We're going to trade in the direction of the anchor chart swing, and we're going to expect movement when we have a high degree of energy. So this is how the chop index can help us here. It's not going to show us what direction to go in. We'll simply trade in the direction of the anchor chart swing, but allowing us to understand the context. Is it in range contraction? Yes. Or range expansion? It's not really in range expansion yet, although it is starting to come in just a little bit here. You can see this starting to come in, showing somewhat of a linear trend to the downside right now. Okay, let's see if anybody... So we could probably do 2 straight hours on how to build a short-term trading system like this, because what I'm not showing is like, how do you take the signal over here? So a signal on something like this, what we might do is we might add, so let's select this pane over here. We might add something like, oh, let's see. And as soon as I do this, I'm going to get into trouble here because people are going to say, well, why that one? So we could add something like a Fisher transform. A Fisher transform would tell us, like, if we come up with a rule that says, okay, this has got to cross above the 0 line, and it's got to do a crossover on the Fisher transform. So there's the Fisher transform. Here's potentially the next setup if this one crosses over here, because what do we have? We have an anchor chart swing to the downside. We have a lot of energy, okay? And what we'd be looking for is some type of crossover on the Fisher transform or whatever oscillator that you want to use. It doesn't really matter, whichever one is your favorite. I find this one to be fairly responsive. And I think I went over this in the short-term trading program as well too. And that's, that's something that you could consider. So again, the context comes from the top down. The context comes from the top down. What is the trend of the swing? What condition is it in? It's kind of not really trending right now. It's more of in range contraction. It really has been for a number of weeks now. It has been in range contraction, But within that range contraction, it is starting to swing to the downside. This is what the Heiken Ashies are telling us. It's starting to come in a little bit in energy. So on the signal chart, this is where we look for the next signal. Now, we can also use the context of this. We can say, hey, look, we have exhaustion almost on the signal chart. And if it reaches up a little bit further, then it will be exhausted. And maybe that's a point where it'll turn over like this. Okay. So again, kind of a deep topic, but that's hopefully I've been able to give you a little bit of how you can use fractal energy on intraday. Again, it's not direction, it's the context. So one time frame at a time, use an anchor chart, use a signal chart, and understand your context of your anchor chart. You know, you're going to ask it to do something that is probability-wise not going to happen, or are you going to put yourself in a good position where you can kind of trade with the trend and both trends are going in the same direction? Okay. If I did not answer this for you, checkmate, let me know. Or you can tell Mav next week and have him buy you beer. Okay. Let's see. Got to look past the microphone. I have a question about the market update yesterday. At the time of this video, why didn't you consider this an uptrend? Is that there's higher highs and higher lows in the weekly chart? And why do you like to see it consolidate for another week or two? Aha. Well, let's get to, all right, let's continue with this one. All right, so let's go to just a straight price and volume chart. Here's where we have to figure out. Now, does this look like an uptrend to you? Now, there's potentially a higher low here. So let's zoom in on this sucker. We're going to zoom in on this right here. And this is where it's easy to get lost in the mud. It's easy to get lost in the mud. All right. So a lot of people will look at this and say, my God, it's an uptrend. Here's the beginning of the moon, you know, like that. You'll read out on Twitter. You'll see all kinds of crap like that out there. But this to me is like, you know, look, if it was truly in an uptrend, what you would see is, well, for an example of that, let's just go back to 2017. You would see something like this and this and this, right? So that's an example of what an uptrend looks like. So let me go back to this one. Does that look like an uptrend? No, right? This to me looks like a bear flag. And pattern recognition, you can use, there are charting packages that are out there that will do pattern recognition for you if you're having trouble getting those. At some point, I'll get those flashcards that I built back before the Stone Age. I'll get those posted in some kind of content area somewhere. So for those of you that don't know the basic 25 patterns, we'll get that out there. But this to me is a bear flag. And not just a bear flag, this is, if we have to give it a name, we'll call it a bear flag. But right now it's really a consolidation. This is what's happening because it is weekly chart and exhaustion. That's why I'm making that bold statement to say it needs to consolidate, because right now, after this plunge down, this is flagging out, and I would expect this to go bouncing around and driving everybody nuts for another few weeks until we start to see the energy build up again. And then, given the context of that, we'll start to anticipate another big move. Now, which way is it going to go? I don't know. This is why we box in the price action. We'll use those alerts, or maybe even alert on the trend line. We can do that too. We can edit the alert on this trend line. Let us know when it's breaking down from there. Okay, so I think we have cleared the deck. We have cleared the deck, and it only took an hour. All right, so let me know if you guys have anything else that you want me to bring up or answer, anything like that. Let's see. There's one that came in, Crypto Maniac. When would you use the 5x ratio and when the 25x ratio between anchor and signal chart? Crypto Maniac, great question. This is kind of what we're looking at. This is the 25x versus the 1x. You know, we could also go over to, we could say, let's go to the 1 hour chart. And it depends kind of on, you know, your ability to be able to read what's going on. Like there's times where I'll use the daily chart as my signal chart. And this is typically if I'm doing swings on like equities and things like that. So I'll use the daily chart as a signal chart. And does it really make sense to use a monthly chart? The monthly chart would be kind of that 25x. I mean, it's really 25 times, you know, assuming that there's about 25 days in a month. Then you could say that, right? But it's too big. It just doesn't move enough. So for that pair, I will use daily and the weekly. Now, intraday, when you get down to slicing little time frames, and especially things like tick charts or range bars or things like that, this is where I will typically do 1x, 25x, and sometimes even, well, hello. I have a helping animal here. Sometimes I will even use 3. So for like when I trade the NASDAQ futures, I will use 25, 5, and 1. So I'll use a triple pane for there. It helps to have a little bit of real estate on the monitors. But again, don't go crazy with that stuff. So hopefully that makes sense. Crypto, you know, like I wish I had a patent answer for that. You just have to look at what you're trying to do. You have to look at the time frames and say, does it make sense? You know, am I able to see what's going on here at the 25x? If I can't, then let's move down to the 5x and 1x. Okay. Oh, Rajith, what are your thoughts on Elliott wave principle and charting? Okay. I'll give you one thought on that. First of all, a sip. Excuse me. So one thought on this Elliott wave. I'm a let's do this. Let's go over to here and use this as a blackboard. I like the 5-wave pattern. I think there's a lot of validity for the 5-wave pattern. Typically the 5-wave pattern is coming from some kind of counter trend. And so the first wave comes along, and that's the smart money. And this is where you've got shorts covering off the bottom. You've got the smart money pressing the hammer on things. There's no retail money involved at all. Retail money is the shorts that are being covered at the bottom. Those are the retail traders are on the wrong side of the price. Wave 2 is basically profit taking and the new bears trying to get a better angle on things, and then they get squeezed out on wave 3. Now, wave 3 is typically the longest one that's up there. I know this is not exactly what you asked me, but I'm telling you why I like this, because of the psychology behind it. Wave 3 is when most of the big money comes on board, and some of the smart retail gets on board. Okay, so at some point, wave 4 comes along. Wave 4 can get really ugly. This is where the institutions will take profits, or the whales will take profits, and the new shorts get on board. And then wave 5 comes along, and this is when retail finally says, okay, I feel comfortable with this. I feel comfortable. This is acceptable. You know, they're not on board for wave 1 or wave 3 or wave, you know, finally a wave 5 is usually when they're getting on board. And this is why the ABC corrective shows up. So that's A, B, and then wave C. Wave C destroys them all, because this is what's really, really interesting. If you understand the psychology behind this, this wave here looks just like another pullback. Looks like another pullback that's going to, you know, head higher like this. And it just kneecaps everybody. So this is what I would say. If you want to learn Elliott wave, just learn the 5-wave pattern. and watch how it unfolds in different time frames. I see it intraday, I see it on larger time frames. Here's where I think the Elliotticians get it wrong. They get so, what's the word for it? They get so rigid with the wave counts. They get tunnel vision and they can't actually see what's actually happening. And so I think there's this sort of notion that they can predict the future, and they're awfully confident of their wave counts, and everyone, oh, well, this is clearly wave 4. Well, what if it's not wave 4? What if it's just another, what if it's instead of a 5-wave pattern, we're going to get a 7-wave pattern? You know, this is where I think they get it wrong. Again, don't get so fixed in on something that you can't see what's actually happening in front of you. So I do like the 5-wave pattern plus the ABC corrective. Actually, if you look at Chainlink, take a look at Chainlink and you can see the Elliott wave pattern playing out. Right now, it's actually a really nice charting coin. It looks really good. That's about the only one that looks really, really good right now, right? But so that's my 2 cents on the Elliott wave pattern is understand why it's there, what it's for, but don't get so locked in that you can't see what's going on right underneath your nose. Okay? Anybody else? Anything else? All right. If I missed anybody's stuff or if something wasn't totally clear, let me know. You guys know how to get a hold of me. I know you do. And so let me know. And you guys have a great weekend. All right. You guys have a terrific weekend. For those of you that are in the United States, duck and cover. We're going to be getting some snow. We're going to be getting some snow here pretty soon. So we're going to be buried with that. All right, guys. Thanks again. Have a great weekend.
There goes a sight from my soul. There goes a sight, there goes a sight. Now there goes a sight from my soul. There goes a sight from my soul.